So you're new to property, how the hell do you work out what makes a great deal? Well, great news, that's what I'm breaking down in today's video. So let's jump straight in, and if you wait until the end of the video, I'm going to show you a piece of software where you can do all of this all in one place for free. So we're going to focus on something called ROI. It doesn't really have a place in property, and yet a lot of people say ROI as if it means the same thing. Now, typically, ROI means return on investment. It doesn't take account of your time, like you might have heard of ROTI, R-O-T-I, return on time invested, and a load of other ones. ROI, the reason it's not typically used in property is because leverage comes into play. And by leverage, I mean debt, mortgages. So if you think about your average investment, let's say I put £100,000 into stocks and shares, and I get a 6% ROI, return on investment, that means I will make £6,000 profit. But actually, it doesn't really mean the same thing in property. It's broken down into three separate figures, and then that's pre-tax and post-tax. This is, in my opinion, the easiest way to understand it all. So, the first ROI is called yield. The second ROI is ROCE, and I'll break that down. And then the third is IRR, which is internal rate of return. But what we're going to do is call that combined returns. There we go. Combined returns, okay? Now, this isn't a technical analysis. I'm telling you how to figure out what makes a great investment. So yield, first of all, let's start with that. Let's rub these off. Yield. Yield is very simply the annual rent divided by the purchase price. That's it. And then you work it out as a percentage. So let's say I get £600 a month from this little property here, and there's 12 months in a year, and I purchased it for £100,000. Well, that is going to come out as 600 times 12, 7,200, divided by the 100,000, it will come out as 0.072, which is 7.2% as a return. So your first ROI is 7.2%. That is yield. You'll also hear it called gross yield. Now, gross yield just means before taking off all of your costs. In fact, it's the only yield, but you'll have a lot of newbies saying, what's your net yield and stuff like that, which means after all costs, doesn't matter, irrelevant. That figure on its own doesn't really mean much. It's more of something to compare against another property. So if another property says, I don't know, it's going to be an 8% yield, from a rental perspective, it's getting a better return on investment. So yield only shows the rent versus the purchase price. So it only really shows you the first part of a return of property, which is the rental income. Just so you know, rental income only represents up to a max of 30% of your wealth in property. In the majority of properties, it's going to represent more like 20%, which brings us on to the next level, which is ROCE, return on capital employed. So we're going to keep the same example of the £100,000 property, the rent is £600. So what is ROCE? Return on capital employed, or ROCI, return on capital invested, is really working out what you're going to get pound on pound from your rental. So I'm going to put an R here. That represents rental. This is also a rental ROI. This is more accurate for you to understand what you're going to end up making. So, for example, let's say we've got a £100,000 house, as we do. We're only going to put in a deposit of about 25%. So just very roughly on this, we're going to have a 25k deposit, 25% of 100. We're going to have stamp duty, which is going to be about, well, it's going to be 3,000, which is 3% of that. Just going to put deposit there. Stamp duty. Let's say we're also going to have legals of 1,500. Broker of 500. Broker at 500, so we're at 28, 29, 30 grand so far, and then we're going to say another £10,000 for a refurbishment. It's just as an example, okay? So we've got a refurb there. So that's 40,000 all in. And then what we've got is we've got that rental to go against it, right? So we've got £40,000. That's the figure to be remembering right now. So we're going to wipe this out and just get the cash in. So the cash in the deal's £40,000 as we went through. So if we need the return on cash employed or capital employed, we need to know what return we're making on that 40,000. And hopefully this is giving you an idea of where we're going. So again, we've got £600 a month. So that's going to be 7,200 on an annual basis. And bear with me, by the way, because if you're struggling with the numbers, I'm going to show you somewhere where you've got all of this in one place done for you. And I'll show you a real example of this. So you're going to have your mortgage and other bits coming off. So let's say your mortgage, which is the 75% of this, because you're getting the debt in, that's going to be 75,000. And let's say you've got the money at 5%. Okay, so easily you just work out what it's going to cost you, because mortgages for buy-to-lets are interest-only mortgages. So that's going to be £3,750. So you got £3,750 for the mortgage cost, but then you're going to have your management fees, your maintenance, your void periods, etc. coming off of that as well. Now, my top tip, just for a very quick number session, is take another 25% off of your yearly rent figure. So that's going to be 3,600, 1,800. So 25% of your yearly rent is going to be £1,800. Now, you might actually get it a lot cheaper, but it's better to factor that in just so you've got an idea of what the returns are actually going to be. So we're going to add these two costs up, so the 3,750 and the 1,800, which is going to bring you to 5,550. There we go. So 5,550. That is the total cost. So I'm just going to make sure you've got that. I've done the mortgage, which is 75 grand, and I'm paying 5% on the interest rate, which is costing me £3,750 a year to borrow that money. I've then taken another 25% off of the yearly rent to factor in management, maintenance, etc., which is 1,800. I've added them together, 5,550. That gives me the total cost. So then, let's rub out these workings so we keep it nice and simple. Then what we've got is our income and our costs. So we're going to minus that off, the 7,200 minus the 5,550, which is going to give me 1,650. And to get the ROCE as a percentage, we're going to take that 1,650 and divide that by 40,000. Now, hopefully these numbers are coming in. So that's going to be 4.125%. Oh, numbers, baby. Not that I'm cocky. All right. So 4.125%. Now let me write that down. 125%, because you might be thinking, what the fuck just happened there? Okay. Now, return on capital employed. If you're not a numbers person, let's just think about it. If you've got capital, cash invested, what is the return on that cash from a rental perspective? The way we've done that is we've taken our yearly rent, taken off our mortgage costs, our management, our maintenance, and our voids, which was the 5,500, which shows us our profit, which was the 1,650. So if we're making 1,650, we divide that by our 40 grand, and that will give us a decimal place, okay? And it will show us. So it will actually come out as maybe 0.04125. Always times the decimal by 100. It gives you the percentage. Sort of? Yes. All right. So 4.125%. But Jamie, there's not just rent that comes into play. There's also capital appreciation. Yes, there is, Trevor. You're absolutely right. So let's look at, what the fuck is wrong with me? Let's look at the final one. which is the IRR, the internal rate of the return, or there's a complicated number for that. I've actually done a video on the breakdown of that formula. It's fucking geeky. So we'll just go with combined returns, which for me, very simply, a way of thinking about this is your rent plus your capital growth. Let's do some workings on that. Here's one I made earlier. That just happened in a second for you, but took me ages. So, just a reminder, we've got this beautiful house with blue trees outside, which obviously means it's going to have great capital growth, right? So, just as a reminder, I've broken down all of the costs here, which brings us to £40,000. That's the cash in. So, what is the combined return? Now, pause the video for a sec. Don't pause it yet. Listen and then pause it. Go in the description right now. I have put a link to LendLord on there. Use that link and make an account quickly. It's completely free. And if you use the link below, you're actually going to get access to all of the premium features for free for up to 6 months. So go and do that now. I don't get any money by you clicking the link and registering your details, all right? So go on there because it's going to be really important for you to go into, and I'm going to show you where all of this is in one place for you in a moment. Go there, pause, and now you're back. All right, cool. So now you've got that. Let me show you what combined returns are. And this is representative of the true return of property. So what do I mean by combined returns? I mean your rental profit plus your capital growth. Sometimes you'll hear it as capital appreciation. Average capital appreciation or capital growth in the UK is 7.9%. But let's say it's 5% capital growth. Now, 5% of your capital growth or your appreciation is increasing the value of your asset. This is done through supply and demand, inflation, and a few other things. So 5% is not 5% on your cash. And this is the bit that really blows people's mind, because people go, why would I bother getting a mortgage? Why would I use leverage when I could just buy it in cash and make more money? Why would I get 4 properties and make the same? Because of capital appreciation. So 5% on top of a £100,000 house, which this is £5,000. Notice how this number is bigger than this number. What? I know. That's why around 80%, 75% to 80% is made through capital growth over your wealth. So we have got 6,650, and that is our combined profit. Then to get that as a percentage, we then do the same thing. We divide it by £40,000, which again will show you a decimal place, but it should come out as 16.625%. So 16.625%. So let's go back to the original screen now, where we can see them all in one place. So here it is, guys. You've got your yield. Anything between 5 and 7% is a strong yield, but really it's a comparison metric. ROCE is your rental profit as a percentage on an annual basis, and it's a really good indicator of, am I making profit as this is going on? And for me, for a boring vanilla buy-to-let property, I want to make sure it's washing its face. And then combined returns, or the internal rate of return, it's a bit more complicated, but think of this as a simple version, is your rental profit plus your capital growth. And this, for me, is the game changer with property, and why you shouldn't be focusing on cheap and cheerful areas because you get a better rental return. Focus on the capital growth areas and you will make more money. It's very much like that saying, price is what you pay, value is what you get. Focus on the value and your combined returns will be so much higher. Now let's jump into LendLord quickly. And again, if you haven't done this, click the link below. Please, please, please make sure you get it. At the moment, they're giving everyone that goes through that link 6 months of the premium features for free, which will blow your mind. And no, I don't get a penny from you clicking that link and registering your details. Okay, so go on there now. And I'm going to show you how you can get all of this in one place, because ultimately this figure here is why you should only ever invest in property, and it just absolutely blows every other investment vehicle out of the water. Let's jump into the video. Okay, so I'll quickly show you this. This is LendLord, and as you can see on the left-hand side, you've got 3 separate sections. Investing, this is really like property sourcing, you're analyzing. This is the managing your portfolio, so you've got portfolio insights. It tells you when your tenants are leaving, have they paid, maintenance reports, transactions, profit and loss. And of course, you've got finance here. So this is the big bit about LendLord. You can get their financing through the bridging and mortgaging. But let's jump into the deal analyzer. So I've put it on rental, and I've put in a property that I actually own. It's on Balfour Road in Bentley, which is in Doncaster, DN5. Absolutely love that area. And I've put in the purchase price, 85,000, rent at 550. And then we've got, I've put interest rates at 6% as the current market kind of reflects that, but naturally that's coming down now as well. As you can see here, we've put annual property appreciation at 5%. This is on the long-term assumptions. And for the sake of this demo, I put the annual rent appreciation and annual inflation at 0. Inflation, obviously a real thing. Rent appreciation, also a real thing. And the property appreciation is usually a lot higher, which is great. But really, it's just for this. And what you can see is all of that I've just very quickly explained in about 15 minutes is here in seconds. So you've got your yield here, which is the first one I went through, the 7.43%. You've got your cash on cash return, or return on capital employed, which is 6.59%. And then you've got your IRR, or your combined return, and this is the 15.91%. So those three figures that I showed you, this is it here, all in one place. So 7.43%, 6.59%, and 15.91%. And it's got some added bits on here like DCR, GRM, which you can look at in your own time. But as I said, get downloading this and you can get free access to all of this. So you've got absolutely everything all in one place. I hope you got value from this video. If you're new to the channel, make sure to hit the subscribe and the notification bell. I've got loads of valuable videos coming up that really will push you to the next level. I also just want to say a special thank you to today's video sponsor, LendLord. LendLord has been absolutely pivotal for me over the last couple of years. As you can probably tell, they're not just a random sponsor. I use them regularly. I use it to finance deals, analyze deals. I've got my portfolio on their system, and it's completely free, and it won't be forever. Remember, if you haven't already, click the link in the description now and you get 6 months of premium absolutely free. It will, I promise you, it will blow your mind, and come back and leave any feedback so I can feed it back to them so they can improve it again and again and again. As I said, if you're new to the channel, hit subscribe, and I'll see you in the next video.